Welcome back, everyone, to this explainer on Siemens Energy AG. Look, we're diving straight into a company today that has quietly morphed into one of the absolute hottest topics in the European industrial space. They just posted a truly record-breaking quarter, but, and here's the catch, Wall Street is completely torn on where this stock goes from here. Let's find out why.
So let's kick things off with a pretty fascinating question. Why on earth is a traditional, legacy, industrial company suddenly sitting right at the beating heart of the AI revolution? Well, the narrative around the energy transition is shifting, and it's shifting fast. It's not just about slapping up wind turbines and solar panels anymore. We're talking about massive demands for reliable baseload energy, gigantic grid infrastructure upgrades, and of course, the literally unprecedented power appetite of AI. And Siemens Energy, they sit right squarely at the intersection of all three of those drivers.
Section 1. A record-breaking quarter. Let's just go ahead and unpack the financials for their Q3 fiscal 2026 blowout performance.
17.9 billion euros. That's the record amount of new order intake they managed to secure in this single quarter alone. It's a frankly staggering figure, and it really just highlights the sheer, overwhelming volume of demand rushing their way right now.
And to ground that massive number in reality for a second, just look at their book-to-bill ratio. It's sitting at 1.57. Basically, for every €1 of revenue they generated, they booked an extra €0.57 in brand new business. That is exactly what incredible operational momentum and real structural growth looks like.
Oh, and that top-line momentum translated beautifully to the bottom line, too. Revenue hit a record 11.4 billion euros, but the real headline here, profit before special items more than tripled. It hit 1.62 billion euros, which pushed their overall profit margin up to a really impressive 14.2%.
Now, for those of you laser-focused on cash flow, the news gets even better. Pre-tax free cash flow surged to 2.3 billion euros. We're talking real, tangible cash in the bank, and that puts the company perfectly on track to return up to 3.6 billion euros to shareholders through dividends and share buybacks this fiscal year alone. But wait, here is the absolute crown jewel of this entire report, an order backlog sitting at a mind-bending 162 billion euros. In the industrial sector, a backlog like that acts like a massive financial moat. Management actually noted this covers roughly 95% of this year's expected revenue and 87% of next year's. I mean, that virtually bulletproofs them against any near-term economic hiccups.
Okay, Section 2, the engine. Let's look at the divisional breakdown and see exactly where these phenomenal numbers are actually coming from.
This breakdown right here illustrates the core engine of the company beautifully. Look at gas services. Orders hit 10 billion euros. That is up an incredible 62% year over year. Why? Well, because gas is acting as the crucial bridge fuel for the energy transition, driven in large part by those power-hungry new AI data centers popping up in the US, plus some major infrastructure projects over in the Middle East and Asia. Meanwhile, you've got Grid Technologies. That's currently their most profitable division at nearly a 20% margin, and they are directly cashing in on global electricity network upgrades. Oh, and even their Transformation of Industry division grew by a very solid 32%.
And now, the moment everyone watching this industry has been waiting for. Siemens Gamesa. Yep, after years of painful losses and absolute headaches over quality control issues, the wind division has finally returned to profitability. They posted a 75 million euro profit. This is a massive signal that the bleeding has stopped, and the operational turnaround we've been promised is actually taking hold.
Moving on to Section 3, the market debate, bull versus bear. Now, if the company is firing on all cylinders operationally, record backlog, surging margins, the wind turnaround, why on earth is the broader market so deeply divided on this stock right now?
Basically, we are looking at a massive tug of war. On one side, you have the bulls, who see unstoppable operational momentum and massive structural growth driven by the macro environment. But on the other side, the bears are warning loudly about an expensive valuation and what they call peak cycle economics. And as an explainer, our job is to step back and objectively weigh both sides of this argument.
Let's unpack the bull case first. The core argument here is that these tailwinds from AI, electrification, and grid modernization, they're structural. They are permanent. Major investment banks agree with this. JP Morgan, for example, just reiterated a buy rating with a highly optimistic €245 price target, which suggests some massive upside. You add in that €162 billion fortress of a backlog, plus the rebounding Gamesa division, and the bulls see a very clear, paved path to long-term value.
Conversely, though, the bear case is equally compelling, and we really have to address it head-on. Morningstar explicitly warns the stock is overvalued. They set a fair value of just €140 compared to a recent market price hovering up in the 150s. Plus, Barclays actually downgraded the stock, specifically citing those peak cycle economics. So what does that actually mean? Well, Siemens received orders for 50 gigawatts of gas turbines in just 6 months. The catch is, the entire world only demands about 80 to 90 gigawatts a year. So bears are arguing this means orders were heavily front-loaded and a huge slowdown is pretty much inevitable. Lastly, bears point to a $5 billion mark-to-market obligation, which is essentially a forced buyout at high prices to secure their stake in Siemens Energy India by 2028. That could really tie up cash and severely constrain future shareholder returns.
Section 4, the verdict. Key investor takeaways. So where does all of this data leave you, the investor, looking to make a smart decision?
Based on the source data we've looked at, here is a quick 3-step checklist for you. Step 1, watch the AI demand. The actual sustainability of this massive data center buildout is your single most important macro variable. Step 2, keep a close eye on Gamesa. Yes, it's back in the black, but if it slips into losses again, market confidence is going to evaporate instantly. And step 3, maintain valuation discipline. You really have to decide if a valuation hovering near €150 billion fits your own risk profile, or if you're better off waiting for a pullback, just like the bears are suggesting.
Oh, and as you track this stock, definitely mark your calendars. Keep your eyes squarely on the August 25th Supervisory Board meeting. They're going to be conducting a strategic review of that transformation of industry division, and honestly, that could serve as a major near-term catalyst for some further structural changes.
Which brings us right to our final question for today. Siemens Energy is undeniably executing a phenomenal operational turnaround right now. But is operational perfection today really worth the peak cycle valuation risk of tomorrow? Whether this is a brilliant investment for your portfolio depends entirely on which force you believe is stronger, the unstoppable gravity of the AI revolution or the inevitable slowdown of a cyclical peak. Thanks so much for joining me for this explainer, everyone. Until next time, stay curious and keep learning.